Today we're going to take a peek at a new product offered here in the Chicago market called the Aetna Funding Advantage. This is a product that many brokers are looking at right now in the fully insured market as their clients' renewals continue to rise, and they feel that there's no real alternative approach to how we administer these employee benefits. My name is Josh Graham, and I am the sales manager here with Flexible Benefit Service Corporation. And my goal is really to partner with brokers and help them grow their revenue and bringing new ideas to you that keep you competitive in the market. So first we need to discuss why Aetna Funding Advantage. I think that it's important to understand where we are coming from and what new products are out there and why they are being talked about and sold right now. We're going to go through the different product design, some of the quoting and installation. That's a simple process and can actually be faster based upon the size of your group. We're going to go through some of the reporting and year-end accounting that's available with these products, very unique, especially if you've spent the most of your time in the fully insured market. And then we'll talk about commissions and bonuses. First off, why Aetna AFA? Like I said, it's kind of important to know where we've come from. Obviously, fully insured groups are dealing with community rates set forth by the Affordable Care Act. There's additional regulations with the fully insured groups that are challenging to many small business owners. Your benefits are really set in stone. You can't make any changes. There's not a lot of flexibility there. You've got increasing cost of care every single year that's not directly related to your particular risk. There's a real lack of cost transparency to kind of build on that even further, where you're getting a 15% renewal increase, but no one even went to see the doctor that particular year because you're dealing with state-based pools. So changing to an alternate funding type approach can really offset that. And this is what I mean. So the Affordable Care Act, if I'm a lower than average claim experience group, I'm right at the average claim experience or potentially a higher than average claim experience, my rates are exactly the same with a fully insured group. And on this illustration, just for that purpose, it's $420, regardless of the claims utilization that's going on within the group. By utilizing one of these level funded type products on a lower than average group, the younger, healthier groups out there, you can see premiums 25% less expensive, even more in some cases that I've seen so far with the quotes coming out. Even when you get into your average groups that are having some normal utilization, you've got a couple older people, you've got some younger demographics offsetting that, we can still see some pretty good savings compared to that fully insured market. Now, there are going to be groups that are just not a fit for this type of program. Those are going to be your older, higher utilizing groups that you really would want to keep an eye on, as maybe fully insured is the best option for you, unfortunately. Group sizes that Aetna is going to be looking at, they can basically offer this down to 5 enrolled lives, up to 50 average total number of employees. So that's really important to keep in mind as you're thinking about the groups that you currently have in your portfolio that could benefit from this type of program. Talking high level about how the product works, the customer or your client would pay a flat amount each month, and it would fully fund the claims liability upon termination. Aetna uses the funds that have been paid into the account to cover all the claims. Basically, being the health insurer, that employer client has funded that. Aetna is just facilitating that claims payment, facilitating the process of determining whether a claim is approved. And ultimately, at the end of it, if there's money left over in that claims fund, there is a sharing of that surplus back to the employer. Aetna has 2 options. You can choose one or the other. The quotes that will come out from our office are automatically going to choose the 50% return of surplus. If you wanted 100%, there is a 10% surcharge on premiums. Ultimately, when we're talking about these types of products, the idea is to get that price point as low as possible to guarantee savings for that employer client, which is why we recommend utilizing that 50% fund. But if you are a gambler and you'd like the opportunity to get 100% back, that is an option. Talking about some of the product designs, and we will go into the actual details of level funding and what makes up those premiums, but let's look real quickly at the products that are available. There's 27 different plans available right now, 30 of which, or I should say 30 are going to be available on 7/1. Open access plans, so these are traditional PPO plans. Deductibles are going to range from the ultra rich at about $500 up to $6,250 for some of your high deductible type health plans. As I mentioned, you are going to have access to a full PPO network. We'll look at some of the other markets. There are some accountable care organizations that are available as well if you're doing business outside of Illinois. You're going to have simple co-insurances ranging from 50% up to 100%. Your preventive care coverage will be built in. You'll have traditional co-pays available through more of the plans that would allow you to see your doctor, whether it be a primary care or specialist, at a set co-payment, and then a traditional prescription drug card that you'll have access to. We're really going back to pre-ACA and looking at how we did business. Let's underwrite the risk. Let's make the benefits simplified. Let's not confuse people with networks. And let's make sure that people that are going to run well have an affordable premium that makes sense for their utilization. This is kind of a graph of the different ACOs that are available across the country. If you're curious about what network Aetna is going to be using, because you may be familiar with some of the networks that they rent out, the Choice POS2 Open Access is going to be the network associated with this particular product. And what's unique about it, in every region across the country, whatever network discounts available to Aetna that are most advantageous are going to be applied to all the claims that are run through here. So if you have employees located outside of Illinois, if they reside in different states, whatever the deepest discount is for that particular doctor, that's what that individual is going to get. So it's really hitting on simplicity once again across the country. Talking about quoting, for any of you that work in the fully insured market, quotes are very simple and similar to what you are used to. You'll need the name of the group, the address. We'll need your broker information. We'll need the total number of eligible. The enrolled employees obviously would be on your census. We need to know the average total number of employees, because once again I said that this product is really focusing in the under 50. There are some states that go up to 100 with it that are a little bit more competitive. Illinois is not one of those currently. And we'll need a member level census. This is pretty common right now in the market. It's actually used, as you'll see here later, for underwriting, so it's important to get some of those details up front. Member level meaning we need first name, last name, gender, home zip code, and their election for each one of the employees as well as their dependents that are currently enrolled on their policy. We'll want to know what the effective date is that you're looking to enroll, and then what broker fee you're requesting. Speaking about commissions, when we run our quotes for you, the illustrative quotes, we're going to automatically run their base commission in Illinois, which is $40 per employee per month. You have the ability to change that, so if you're looking for something different, let us know. I think that that's really, really competitive compared to some of the products that are out there in the market right now, whether fully insured or level funded. The common ownership form listed here is no longer required, but it is good to know if there are multiple businesses, because that could come into play when you're talking about your average total number of employees. So reach out to your Flex reps if you have any questions on how to determine that. Once you have your illustrative quote and you tell me it looks good, which many of these are looking really good, then we've got to move forward with the underwriting. And there's really two different processes with this. If you're a group that either doesn't have coverage today or you have less than 20 employees enrolling, then it will require that you collect an individual medical questionnaire on Aetna's paper that would be used to underwrite the particular group. When you get over 20 or 20 or more enrolled, you'll have the ability to go through underwriting via GRX, which is a prescription-based underwriting which identifies certain utilization and medical conditions based on those particular prescriptions. Now, Aetna doesn't get any details on what the script was or who it was for, but they get a rating factor back from this third party that allows them to issue their final rates. We'll also need to know their plan designs, whether that be their current plan design or an SBC is fine as well. Sometimes that's available directly in the renewal that we'll need, and then we'll need a copy of the current carrier bill. With all of this, we'll submit that in and be able to get quotes underwritten. Once that comes into our office, their typical turnaround time right now is about 3 to 5 business days. Obviously, as we get into busier times of the year, that is subject to change. Here's a sample of the individual medical questionnaire that Aetna has. Basically, it's a 2-page app. We're, once again, trying to keep it simple. We're not talking about a 10-page universal here. Front page is going to collect the employee demographic information. The back page is going to collect your simple medical questions, and from there they're done. So very simple process to collect those applications and what you're probably used to in the past. So here's an example of a paperless enrollment that's now available. Basically, your account executive or your flex rep is going to notify Aetna that there is a sold case. The Aetna contact, the sales coordinator, is then going to send out a customer information request form that we would need to complete as the broker and the GA. Once that information is completed, it's sent back to the sales coordinator, and that sales coordinator then pre-populates forms that will need to be signed. Those forms are emailed out in 3 separate emails to the plan sponsor. You get one as the broker, we get one as well. Once those forms are completed, additional documents and enrollment information is then submitted to that particular sales coordinator, and that begins the installation process. Before the case actually gets moved into the install, the support or the sales coordinator is going to review those forms. They're really checking not for medical information at that point because we've already been through underwriting, but they're checking the other pieces like making sure you're meeting participation and the employer is contributing the amount required to meet the group eligibility rules. So those are the types of pieces that will be pre-underwritten and then released into the install team. Springboard Marketplace is going to be the recommended method for getting plan elections back from employees effective 7/1 dates. And this is basically an online marketplace where employees can see side by side the different plans that are being offered to them, the premiums per paycheck that they're going to have to pay for that particular product after the employer's contribution, and really provides more reporting, and you can kind of see where your group's at in that enrollment process at any time. Now, what I think is really cool is a new partnership between Aetna and Apple for any employees, whether benefit eligible or not. I shouldn't say or not. Benefit eligible employees, whether taking coverage or waiving coverage, are going to have access to purchase an Apple Watch for $25. I know those are typically retailing in the $300 range. So it's a huge benefit, and it's Aetna's play to really engage the younger type groups to get them involved, keep healthier trends going. There's a lot of pedometer services available with those watches, and that's their answer to kind of bring more people that are younger and healthier into this market and get involved with these types of products and keep people on a healthier trend. So let's take a quick look at the different components of self-funding. The Aetna Funding Advantage is not a community-rated group, meaning they are going to look at medical information and make sure that it's an appropriate risk that the carrier wants to take on, and they'll underwrite via that GRX process we talked about or the individual medical questionnaires. When they're collecting premiums identifying with the fact that they are going to be collecting the entire funded amount, the maximum liability for that particular client. If the medical costs end up being higher than that, there's no additional premiums that come out of that employer's pocket. You won't get the best renewal at that point, but you're not going to have to pay more money that you were not expecting. If things run really well, there is an opportunity for return to surplus, which we'll talk about. These plans, because they're technically built on a self-insured chassis, are not subject to the health insurer fee, which you may see in many of your fully insured quotes. The carriers a lot of times will break that fee out, show you what it is, because they're really just passing that along. With the self-insured products, that's not happening because technically your group client is the insurer. And there are 4 real simple parts to this fixed monthly payments. You've got your administrative fees, which we'll talk about, stop-loss premiums, claims runout, and claims funding. So if we talk first about the administrative fees, that's going to include the access of that Choice POS 2 network that we talked about. It's going to handle all the customer service related functions for members. It's going to include any fees for banking and premium facilitation, as well as the claims, plan admin, and runout. So that's all included in the administrative fees, which you will not get back. That is not a potential return of surplus. What you do have the ability to get back after you pay your stop loss are the actual claims funding and the claims runout. Well, let's talk about stop loss. Stop loss is basically covering that particular group after a certain dollar amount is paid out. And there's two different types of stop loss. You've got individual stop loss as well as your aggregate stop loss. Individual stop loss for this program runs at $30,000, and your aggregate stop loss is 110% of your expected claims. So you'll be protected on both fronts. You'll pay a premium for those particular coverages, and once again, those you cannot get back because that's the insurance premium itself. But what you can get back is a potential return. So this is an example of your claims runout. You've got your total monthly claims funding plus any claims runout that has been expected based upon medical underwriting. They take a look back for that 12-month period and look at the actual claims paid. And they'll also take a look at the 3 months after that. Month 15 is when the surplus would be returned, with what claims runout have come after the plan year. If you take a look at what they budgeted versus what was potentially paid out, that is what you have the opportunity to get a return on. So the claims funding, they're looking at maximum expected claims, the attachment point at which point that carrier, Aetna, will begin paying for anything above and beyond what the employer was expected to pay. So that goes into the actual claims funding. Your banking overview, this is really important. There are going to be no paper checks accepted for this program. Everything is going to be done via ACH, a monthly auto draft, and really those monthly bills are going to include the admin fees, the stop loss premiums we talked about, as well as that estimated claims funding for that particular group for the month, and claims run out as well. So we're pre-funding for claims run out throughout the year. The 20th of the month, Aetna is going to be looking at the eligibility currently in file, and they're going to base the bill off of that particular enrollment. On the 23rd or the next business day, a bill is then generated and sent to the plan sponsor to let them know exactly what funds need to be moved into this particular account prior to the second business day of the month, where Aetna will pull those funds. So the banking is done through Citibank. It is a bank account owned by Aetna, and that is how all the premiums would then be facilitated to cover these claims payments. Self-insured programs, level-funded programs like we're talking about today, are very unique in regards to the amount of information that you're provided, so that you can really better advise your client and bring more value to yourself in your client's eyes. So within this program, you're going to get on-demand reports that will show you detailed claims data by company. You're going to have more information in regards to the month-to-month that will be generated going out to the employer client, which we'll show you in just a second, as well as you as the broker. And then you also have access to some large claims reports to get a feel for, are there any people that are hitting that individual stop loss level. So this is a sample report that will identify some of the trends in your demographics from prior year to current year. Are we getting older? Are we getting younger? How many employees do I have in that 27 to 34 year range that we're really looking for? So you'll get some more information on that. You'll get some financial breakdowns in regards to your spend and whether it's going to pharmacy, whether it's going to office visits, ER. You can identify some trends with that and work on educational programs with the employees to help them utilize other services instead of ER, for example. You can look at changes in membership from month to month, as well as comparisons of medical premium paid per member. So a lot more information there, as well as year-to-date reports. So you can see the exact premiums that have been paid out for the claims. You can see how your group is running mid-year and actually have an intelligent conversation with your client as to whether you feel that they're going to get a potential return on their premium, whether they're already over their maximum liability and a poor renewal is upcoming. Either way, you're able to provide more information for your particular employer. Taking a look at the potential for surplus return, this is a very simple example in regards to a client that shows the 50% claim surplus. Total claims funding at $300,000, annual claims paid, including your run out of $250,000. The result was a $50,000 surplus, which was split 50-50 to Aetna and the particular employer client. It is required that you renew to get access to that surplus, And the surplus is real money. It is deposited directly into that joint bank account between Aetna and the client. They have the ability to withdraw those funds once they go in if they so choose, or you can leave that money in there to cover future premium payments. Completely up to the client, but it is real money that is returned to them. So taking another look at why Aetna Funding Advantage, number one, you got a potential for significant cost savings for that target group. There's a real nice range of products and benefits available to them, whether you're going for the ultra rich to the higher deductible, and then in between. You've got financial protection with those fixed monthly premiums, which for a small group client looking at level funded or self-funded products is very, very important with cash flow issues potentially. You've got monthly reporting so that you can bring more value as a broker, as well as opportunity for some shared savings at the end of the year. Self-funding, it is designed for smaller businesses within these level funded products. Generally speaking, if you go online and Google self-funding, it'll scare all of your employer clients away. It is important to really present this in the most simple form possible, and that is comparing it as close as you can to fully insured. After you get through underwriting, your rates are locked in for 12 months. They're not going to change on you, and you're not going to have the downside of huge stop-loss premiums, but you will have the upside of that potential return of surplus. I mentioned to you at the beginning of, or really towards the middle of this webinar, about the commissions available to brokers. That is the flat $40 per employee per month. That's what the base dollar amount is. But to really get you going quick, Aetna is offering a bonus program through the end of the year, even to January 1st effective dates, in which they're going to pay an additional $50 per application on that first month, which really means your first month commission is $90 per employee per month. So there's a significant financial opportunity available to you as a broker. Not only the fact that this is something that you need to be talking to your clients about, given the market and the fact that everyone is dealing with higher renewal increases year after year, and they need other options. I guarantee you, if you're not talking to your client about these programs, that there will be someone else coming in the back door to do so. So get in touch with us immediately. We're happy to start quoting. You can contact our general inbox at groupsales@flexiblebenefit.com or call our office at 847-699-6900 and ask for a group sales representative. Thank you very much for attending us, and we look forward to working with you.